I'm with Victor Khosla, who's the founder and CIO of Strategic Value Partners. Victor, usually when someone's sat in the seat opposite me, it's to tell me how great everything is. The economy's doing wonderful, their company's going gangbusters. For you to prosper, you need to find cracks in that narrative. So where are they?
The cracks today are much more, they're smaller. In a strong economy, it's hard to kind of have a lot of cracks. But when we look for opportunity today, we're looking at Europe. The European banks are still cleaning out their balance sheets, 100+ billion euros a year. And then there are some really interesting industries, predictable businesses like infrastructure or liquidations and bankruptcies. But that's sort of the focus today for us.
Now, you say infrastructure. Tragically, we saw last week the collapse of the bridge in Italy. Would Atlantia be a company that would be being looked at this point by distressed investors, or is it too early?
It's way too early. The company has still 10+ billion euros of equity market value. It's fallen, it's collapsed, but even after that. So the debt trades at over 100 cents. Way too early to think of it as a distressed investment.
Now, an area you have made a lot of investments in recently is toll roads. I think you have about 10 in the portfolio. What is it about those particular assets that attract so much attention from distressed debt investors?
You know, we love toll roads. It's essentially what you have is you've got a monopoly or a duopoly, and you've got 45, 50, 60 years in terms of how long your toll road concession lasts, right? So there's a predictability about cash flows, and there's a defensiveness about cash flows. And as a result, when we can find those kind of investments, we find them really attractive.
But you see, it's interesting. I remember covering infrastructure companies at the beginning of the sort of recovery, 2009, 10, 11.
Yeah.
Toll roads were supposed to be the sort of darling early cycle investment. They were safe, they were predictable, pension funds could own them. And now they all seem to be owned by distressed guys. So what went wrong?
No. That's not quite right? So today, look, if you've got 100 toll roads, there are 5% of them are distressed, right? So it's a small proportion of them which kind of go wrong. The recipe, the deals we've focused on and what we've invested in, there are really a few things which made it happen. So one is just plain old leverage. You know, these deals, because they are predictable, the banks lend them money. And some of them people have bought toll roads with 15%, 15% equity, 85% debt, right? The second thing, which has gone wrong, and this is combustible. Some of the sponsors have gone out and done these interest rate swaps, hedging fixed to floating. Interest rates came down, the swaps have ballooned. So you marry the two things together, you can't take even little bits and bobs in your traffic. You have a little problem, it just gets compounded with kind of what you've just created, and you've had these collapse in toll roads.
And a lot of this debt, even when it relates to US assets, is actually being written or has been written by European banks.
Yes.
So I think as a European, I could probably ask this reasonably, but what is it about European banks that it means it's so consistently them on the wrong side of these deals?
Well, you know, just focusing on toll roads and the European banks, a lot of the sponsors who invest in toll roads started out in Europe. So the big toll road operators, Macquarie, Sintra, Albertus, I can go on with the list, they are European. That's kind of their...
Well, Macquarie's Australian.
Macquarie's Australian, right? But the other guys are European. And to bank them, the Spanish banks, the Portuguese banks, and some of the English and some of the Germans, right? That's kind of who banked them. So even when these guys went out and bought toll roads in the United States, it wasn't US banks, it wasn't Citibank banking them, it was banks out of Spain and Portugal because they were supporting the local champion.
Let's talk about an area that seems to be in a state of perpetual distress, which is retail, and particularly fashion retail. Is that something where you are investing or spending time, or is it too risky, even for distressed investors?
It's too risky for us. There are quite a few distressed investors in it. when we look at retail today, yeah, it's such a big opportunity. You can't. There are 30, 40 distressed retailers with multi-billion-dollar capital structures in distress today. So we've looked at it. We've really looked at it really hard. And I think to us, Ed, what we found is all these businesses in distress, the distressed retailers, they are in secular decline. We don't know what they're worth. Every year they seem to want to shut down 10% of their store base. So we can't really figure out what is this business worth at the end of 2 or 3 years, right? So as a result, look, we've got other things to do. We're a mid-sized fund. We can be really choosy about what we do. We've tended to shy away. We think large parts of retail, not everything, but large parts are really uninvestable.
So where do you see the opportunities? Which sectors, aside from infrastructure, are you buying into at the moment?
So if I could just step back in just one sense of perspective, right? So year to date, the first 7 months of this year, we've invested $1.2 billion buying distressed debt. In the US and Europe.
But in which sectors?
Infrastructure, liquidations, merchant energy. We bought into some distressed private equity deals in Europe, which we bought at really great prices, special situations. But I think, as a sense of balance, just where we are today in the market and the opportunity, we are buying a lot, but we are selling a lot more than we are buying. So it's important, if I may, just to keep that in perspective. Excuse me, in 2016, we were buying a lot more than we were selling. This was after the oil and gas crash. In 2017, it was about even, right? But just where we are today, yeah, there are cracks. The big cracks, like, the cracks I'm describing, the toll road in Texas we just invested in had $1.6 billion of debt. There's a liquidation in the US we are invested in today. It's got $1.8 billion of debt, right? So there are big cracks here. But it's again, in balance today, the opportunity set is more muted than it has been in the last few years.